Hello traders, welcome back to InvestWatch. Nvidia is at a critical turning point after some major market moving news. In today's video, we will cover the latest Nvidia fundamentals and break down the key technical levels that could decide the stock's next big move. Let's get started.
Welcome to the deep dive. Imagine building a piece of technology so revolutionary that companies have been, fighting in the streets to get their hands on it.
Oh yeah, literal bidding wars happening every single day.
Exactly. But then the people renting that technology out just slash their prices by 31% overnight. That's the paradox Nvidia is facing this exact second.
It's a truly massive disconnect, yeah.
It really is. So today, our mission for you is to navigate these current market crosscurrents. We are going to decode the stark contrast between Nvidia's stellar long-term fundamentals and, the sudden, really glaring warning signs flashing on its short-term daily charts.
Right, because right now we are looking at a literal tug of war.
We absolutely are. And for you listening right now, we are stripping away all that daily market noise. We want to look purely at what the price action, the momentum, and the technical market structure are actually telling us right now. We're equipping you with the exact levels and patterns to watch.
Because that intersection, between what a company is fundamentally worth in the future and what market mechanics are dictating today, that is where the real action is.
Yeah, that's where the opportunity and the risk lives. So before we even look at the lines on the chart, I think we have to establish the underlying tensions here. Nvidia's long-term fundamentals remain incredibly strong.
Oh, absolutely. I mean, it is anchored heavily by the upcoming Vera Rubin platform.
Right, their next-generation AI architecture.
Yeah, and it's a technological marvel. It represents this massive generational leap in processing power and energy. It's the kind of fundamental moat that most tech executives can only dream of building.
But then there's the short term. The pressure is really mounting because of two major factors. First, you have big institutional investors actively rotating their money out of the tech sector entirely.
Purely for portfolio rebalancing.
And second, there is a stark cooling in actual demand. Like we mentioned, B200 GPU rental prices have suddenly plummeted by 31%.
Which is just staggering. I mean, a 31% drop for a product that was essentially treated like liquid gold just a few months ago.
It's crazy to think about.
It is. But you have to remember, stock markets are forward-looking mechanisms. They don't care about last quarter's earnings report. A price drop of that magnitude is a real-time indicator of cooling demand showing up in the market long before it ever hits an official balance sheet.
It reminds me of, think of a wildly popular, critically acclaimed restaurant.
Right.
That restaurant represents the Vera Rubin platform.
Okay, I like that analogy.
The long-term reviews are stellar. The chef is world-renowned. Everyone knows it's the best food in the city. But tonight, the VIPs, the institutional investors, they're paying their tabs and quietly heading for the exits early.
Right, they are walking up before dessert.
Exactly. And the cost to reserve a table, those GPU rental prices, just dropped by 31% to entice people off the street. The food is still great, but the crowd's behavior is telling you the vibe has fundamentally shifted.
Yeah, the vibe has definitely shifted. And the thing about that VIP walkout you're talking about, they can't hide it. Even the greatest companies aren't immune to institutional rotation.
Right.
When a massive fund spends weeks unwinding a position, it physically alters the stock's structure on the charts. They leave giant footprints.
And right now, those footprints are painting a very bearish picture. Let's decode that weakness on the daily chart.
Yeah.
Because Nvidia is currently trading around the $192 level. And crucially, it is sitting below the 21-day exponential moving average, or EMA.
Yeah, and for context, the 21-day EMA is essentially the heartbeat of short-term momentum for institutional algorithmic trading.
That's a big deal.
It is a very big deal. When a stock is trading above it, the bulls are in control, the tide is coming in. But when it crosses below it, like Nvidia has, the tide is going out. It tells us the short-term momentum has officially shifted to the bears.
The bears have the steering wheel right now.
They really do.
But it gets much more concerning than just drifting below an average. The stock has formed a head and shoulders pattern. And even if you only casually follow the markets, you've probably heard this term, it is notoriously one of the strongest bearish reversal signals in all of technical analysis.
Oh, definitely. It's a visual representation of pure buyer exhaustion. Every time the price dips during this formation, buyers try to hold the line at a specific support level, which creates a floor.
And we call that floor the neckline, right?
Exactly. And for Nvidia, that crucial neckline was sitting firmly at $203.
But the price is already broken down below it. The floor gave out. Wait, let me ask for some clarification here. Looking under the hood at the internal engine.
Sure.
Because the RSI, the Relative Strength Index, is currently below 50, but it was also showing bearish divergence previously.
Yes, it was.
If the price was hitting new all-time highs, shouldn't that mean buyers are strong? It sounds to me like a runner pushing for a new personal best on the track. They stumble across the finish line for a new record, but their heart rate monitor shows they are completely gassed and about to collapse.
That is the perfect analogy. The runner analogy is exactly what RSI measures. It looks under the hood of the price action.
So the new high is the finish line, but the momentum is the heart rate.
Yes. Bearish divergence tells us that the final euphoric push to Nvidia's all-time highs was done on incredibly weak volume. It was a completely hollow victory.
Wow, okay.
The buyers were just utterly exhausted. So when the price eventually broke below that 21-day EMA and cracked the $203 neckline, it really wasn't a surprise to anyone tracking the internal momentum. The runner simply collapsed.
So the momentum has officially shifted downwards. Knowing that, let's zoom out and map out this descending staircase. We need to see exactly where the sellers are defending their ground and where the buyers might make a final stand.
Right, we have to look at the structural levels.
So there is a clear descending trend line here. The stock reached an all-time high of $232. That peak acted as the first major rejection point. Then a second rejection occurred near $214.
And that second rejection at 214 is probably the most psychologically damaging part of the current chart.
Why is that lower high so damaging?
Well, a healthy bullish stock makes higher highs and higher lows. When a stock starts making lower highs, failing to reach its previous peak, it proves that institutional sellers are stepping in earlier and earlier.
They aren't even waiting for it to get back to 232.
Exactly. They are so desperate to reduce their exposure that they are willfully accepting a worse price at 214 just to get out.
Which creates our first major supply zone, right? That heavy area of resistance where a massive wall of sellers is waiting to pounce. And that zone sits between $215 and $232.
Anyone trying to push the price up has to fight through that massive wall.
But let's look down at the floors holding this thing up. The current demand zone, the support being actively tested right now, is between $195 and $200.
Right.
But the next major downside target, a much stronger demand zone, is located dangerously lower. It's sitting way down between $164 and $170.
Which is a huge gap.
It's like floors in a skyscraper. If the floor at 195 to 200 caves in whole, under the weight of the sellers, there is nothing but empty air until the price crashes down to the basement at 164.
Yeah, that gap is the precise danger of the current market structure. Because Nvidia ran up so incredibly fast during its bullish phase, it didn't have time to build dense layers of structural support underneath it.
It's like sprinting across a frozen lake.
Exactly. The ice hasn't had time to thicken. So if that thin ice at $195 breaks, gravity just takes over. The algorithms will keep pushing the price lower until they find a zone where massive buy orders are actually waiting.
Okay, so we know where the heavy resistance is overhead, and we know about the thin ice below. Let's talk about the immediate line in the sand. What is the precise trigger point that will dictate Nvidia's path in the coming days?
The absolute most critical level to monitor right now is $191.
191.
Yes. We are specifically looking for a daily candle to break and close below that number, particularly during Monday's session.
So an intraday dip doesn't count as much.
No, it has to close below it. If it does, it officially, unequivocally confirms the shift from a bullish to a bearish trend.
Let's map out the scenarios here. Scenario A is the bearish breakdown. The daily candle closes below 191. If this happens, it looks like the stock might actually briefly retrace upwards to fill a gap around $205 before resuming its brutal descent toward the $170 zone.
Yes, that is a very common structural move.
But wait, let me push back on this. This feels completely counterintuitive. If a stock breaks a critical support line at 191, officially confirming a bearish trend,
why would it bounce up?
Exactly. Why on earth would it bounce up to $205 first? Why would it go up just as the trend turns officially bad?
I know it sounds backwards, but it speaks to the fascinating mechanics of high-frequency algorithms. It's all about filling the gap. When a stock drops violently, it skips prices. It leaves a literal blank space on the chart where zero trading happens.
Like skipping a few stairs on the way down a staircase.
Exactly like that.
Yeah.
And because no trading happened on those skipped stairs, it creates a massive vacuum in the order book. Thousands of unfilled orders are left hanging there.
Oh, I see.
High-frequency algorithms hate vacuums. They naturally gravitate back toward those empty spaces to test the orders and clear out the books.
So when a major support breaks and retail traders panic sell at the bottom,
The smart money engineers a sudden, aggressive short-term rally right back up into that vacuum, up to 205.
wow. So they trap the late buyers who think it's a miraculous recovery while giving themselves a better price to initiate even larger short positions.
You hit the nail on the head. And once that gap is filled, the downward momentum takes over again with a vengeance.
That is slightly terrifying, but so vital to understand. So what about scenario B, the bullish defense? What happens if buyers fiercely defend that $191 level and push the price back above 205?
If they can hold that line, the narrative shifts, at least temporarily. It signals there is still enough institutional appetite for the Vera Rubin story to absorb the selling pressure. Nvidia could stage a short-term recovery rally back up toward that supply zone between $215 and $232.
But even then, they still have to fight through that massive wall of sellers waiting to offload at lower highs.
Right, it's a tough uphill battle either way.
So synthesizing all of this, Nvidia is currently at a really critical decision point. The long-term tech horizon remains bright, but the short-term reality is dictated by institutional rotation, falling B200 rental demand, and a stark head and shoulders breakdown on the charts.
Which means the ultimate lesson here is that patience is essential. Traders really shouldn't guess. They must wait for confirmation, like seeing if that $191 level violently breaks or holds strong. You have to follow your trading plans and manage your risk.
I want to leave you with a final thought to ponder today. When a company's long-term technological dominance, like the Vera Rubin platform, collides with a severe short-term technical breakdown pointing to $170, how do you personally weigh the facts of today against the promises of tomorrow? Especially if AI compute power eventually becomes so abundant that the hardware itself turns into a discounted commodity.
That is the multi-trillion-dollar question for the next decade.
It really is. Thank you for joining us on this deep dive. If you found this analysis helpful, please make sure to subscribe and like the video on our YouTube channel, Investor's Edge. We'll see you next time.